Okay, so viewers, the first point is that today's talking point has to be about what banks are doing and how they're coming up. And Ajay Tyagi, head of equity at UTI AMC, believes that the time may be ripe for private sector banks to actually now start a period of outperformance relative to the public sector banks as well. The Nifty Bank has hit record highs, and the reasons are many, as he's just outlined, but principally the premium that the private sector banks enjoy over PSU banks is the lowest in the last 2 decades, if I'm not wrong. And therefore, that is enough reason for private sector banks now to get a serious look if you believe that financials are going to be the key sector going ahead. Now, just a word really, financials are scaling up the markets. Every single day, we are hitting new highs, so to say. At some point of time, I mean, people will say that the naysayers were negative at 21,500 also. They are negative at 23,500, but there's a chasm of difference in valuations between those two levels, right? At these levels, do valuations spark a serious concern about a further up move in the markets?
So minus the adjective that you used, I would say yes, it's a concern.
Serious. Okay.
So I would say rather than being economical with words, our view at UTI has been that the valuations at which the markets are trading today does load the dice unfavorably for investors, at least from a 12-month perspective. Look, when it comes to investors who are looking at a 5-year horizon and beyond, we always say that stay invested, you can't time the market, it's almost impossible to get in and get out. But it certainly appears to us, given where the valuations are, given where the excitement level is, given where the F&O participation is, so there are these multiple things which are indicating to us that valuations are unfavorable right now. We won't be surprised if markets correct 10%. We won't be surprised at all if markets move sideways for the next 12 months because the valuations are suggesting us that. So, I mean, if I take the valuation picture aside, I would echo what most other people have been saying, which is that India hasn't been as robust in terms of its fundamental outlook ever. The only weak link is the fiscal deficit, and I do hope that the government would be addressing that. There's a glide path that the finance minister has committed the country towards, and I hope that we will be sliding down that glide path.
I thought that with the RBI dividend in play, that is not a question at all, Ajay?
Life changes sometimes within 24 hours. It wasn't a question at all pre the political outcomes in this country, but post that, it does appear that the government may have to loosen their purse strings. They may have to actually dole out money for, let's say, bottom of the pyramid. So it may have some strain on the fisc. The good news is tax collections remain robust. So that's why I'm saying that given the puts and takes around this equation, looks like, we would be able to still adhere to the glide path.
Okay. With an assumption that all of that happens, is the market, and with the earning growth assumptions that you might have for your portfolio companies per se, or the overall markets maybe, because you're benchmarked to the index, Ajay, would you be a confident buyer at a lower level, or would you be a buyer after a period of time if the market were to consolidate? Because earnings will catch up at some point of time in the next couple of quarters too, right? To the multiples.
Sure. That's a good question. And Neeraj, essentially, we're trying to reach to the same level. If there is a price correction by 5–10%, it makes the equation favorable. If prices don't correct but remain sideways, but in the meantime, earnings catch up, it again brings the valuations down to a more favorable position. So yeah, essentially we're talking about the same. And my answer would be that, whether the markets correct outrightly or they consolidate and therefore there is a time correction, our comfort levels would increase.
I get your point. Okay. Now, it may well happen, Ajay, that the markets may consolidate, but specific pockets may do well. I mean, everybody wrote off defense. The stocks have been on steroids, really. There, I don't think you will tell me to mask my words because really the sector has gone through the roof. But my limited question is, let's assume that the markets are consolidating sideways to maybe minor corrective move as well. Where is it that you believe the chances of outperformance is higher based on either policy, based on earnings flow, or based on flows that the market may be seeing, given the promise that the sector may hold for the future?
Sure. So, the way we always approach the equation is that we're always oriented more towards the outcomes of businesses rather than trying to take a view on where could the flows land up. Okay. So we are usually, not usually, I would say we are always oriented towards, do we understand this business? Do we understand the outcomes of the business? Do we understand what's going to either hit the business or it's going to act as wind in the sails and so on? Now, from that perspective, I would say that there are 2 or 3 quarters of the market which look positive to us. We've already spoken about the banking sector. And we did talk about the sector in detail. Valuations are favorable. The construct in terms of growth per se is as strong as it always was. The second sector which we think should now be favorably positioned is the consumption sector, which has many facets. It has consumer durables, it has consumer discretionary, it also has consumer staples. Now, consumption has been weak in this country, and we all have seen the dissected GDP data, which talks about the consumption leg being very poor all through the last, I would say, almost 8 quarters now. 2 things. One, what we have observed in India is that consumption, while it's a structural growth trend, but it too does have its own cycles. We feel that consumption today is at the bottom of this cycle. That's point number 1. So regardless of the exogenous variables, consumption ought to be witnessing an uptick. Point number 2, I think, again, let me go back to what happened at the hustings and the outcomes of that. I think the government does realize that they've actually put in a lot of money behind infrastructure, rightfully so. It has the maximum multiplier impact, but they also cannot neglect the consumer part of the economy. They cannot neglect the consumer at large. So our feeling is that they would be, the government will find ways to put money into the pockets of consumers. That would be the immediate impact on revival in consumption and the different facets that I just spoke about. By the way, valuations in this sector compared to their historical averages are at par or maybe slightly lower in certain pockets. So I think this is the second one. The third one, where we feel that there is a very strong structural growth story and yet valuations are not at crazy levels, is the healthcare sector. And here too, there are multiple dimensions to the healthcare sector. We have the pharmaceutical sector, which is very domestic oriented. We have the hospitals, where the government has realized that, look, we can't spend as much money as the private sector hospitals can, and therefore we must support them. We also have a small subset of healthcare, which is diagnostic companies. And last but not the least, we have discovered that China plus one can be a big, opportunity for a lot of these export-oriented players who can partner with the big pharma. So I think that's another sector where we are finding opportunities. I'm not saying valuations are very attractive, but the valuations are not, outlandish.